Hi everyone, welcome to our channel.
In this video, we will talk about option chain analysis. You all would have came across that stock traders saying option contract. Option chain is nothing but a list of all available option contracts in a specific index or in a stock. In option chain, we have two sides, call option and put option, and both sides consist of strike price, bid price, ask price, volume, open interest, change in OI, last traded price, and even more. These are all the important factors to make a note in option chain. There are two types of options. One is call option and the other one is put option. Call option gives a right to buy a stock. On the other side, put option gives a right to sell a stock. And for the additional information, not all stocks has option contracts. We have more than 6,000 stocks which are listed in our Indian exchange. But not all stocks have future and option. At present, we have around 200 stocks which can be traded in options. In index we have Bank Nifty, Nifty 50 and Fin Nifty where we can trade options. There are three main categories in option chain. Or in other words, we can call it as moneyness of option contract. There are three types: ATM, OTM, ITM. The abbreviations are at the money, out the money, in the money. Okay, if you look at the screen, this is what an option chain looks like. This is an option chain of Reliance. Now I will explain it on the screen. This is the current month's contract of Reliance. Reliance is trading at the price of 2,500. If I analyze Reliance and if I predict that it is going to move up, I'll be buying call option, isn't it? So I must choose a right strike to make profit. In the center column, you can see 2,400, 2,500 and 2,600, right? These are all the different option strikes which can be traded. 2,500 will be the ATM, which is at the money. At the money is nothing but the current traded value of an equity. And in call side, the next strikes are known as OTM, which is 2,520, 540 and even more, 2,600, 700, everything. These are all known as OTM, out of the money, because in call side, these levels are yet to come, right? So this will be known as OTM. And the strikes below ATM are known as ITM, in the money. This is for call option. In put option, the at the money lies at the same level. It will be 2,500, but the OTM and ITM will be changed. For example, if I predict that Reliance is about to fall a bit, then I will be buying put options. So if I predict that it is going to fall 100 points, I will be ready to buy 2,440 or 2,420 or even 2,400 because these levels are yet to come. While these levels are noted as OTM for put option, the strikes below ATM are known as in the money because it is already inside the at the money level. We are seeing this option chain in NSE website. In this page, it has clearly shows that the shaded region are in the money and the blank region is out the money. This is for a reference. By knowing ATM, ITM and OTM, we will be making trades here. Now we will look at other important values in option chain. First one is OA, open interest. If you look at first column in call side and the last column in put side, it represents open interest. Open interest is an opened contract at a specific strike price. It is an outstanding contract held by market participants or traders at the end of the day. If a trader has shown his interest and if he holds his position, it will show in open interest because after buying this contract, he didn't sell. He is yet to sell, but currently he holds the position. So this will show in open interest. How many opened contracts are there in that specific strike? We can even predict a stock price's movement with the help of open interest. It is an important tool for analyzing stock or index movement. Now, change in OA. Change in OA lets us know that how much percent that contract has increased from previous day. If it has increased more, then we can come to a conclusion that people are still about to follow this trend, or in other words, traders are still adding positions on their side. Now we will look at volume. Volume is the number of contracts traded in a security. In simple words, if both buy and sell has happened, it will show in volume. I will explain this with an example. I bought 2500 call option in Reliance and it will show in OA because I haven't sold that position, and after selling it the whole trade is completed, isn't it? So it will change as a volume. Now implied volatility, which is IV. IV shows the price swing of the strike price. If a strike price has more IV, then the premium of the strike has more chance to move higher. Now LTP. LTP is nothing but last traded price. It tells that the last traded price of the premium. It may be in call side or even put side. Bid price. Bid price is nothing but the highest bid amount from buyer's side, and in bid quantity it tells that how much quantity they are ready to buy, and ask price is also the same. Ask price is at what price a seller is ready to sell his contract. In ask quantity it shows that how many quantity he is ready to sell. Okay, now we are almost at the end of the video. This is where an important topic starts. How to pick strike. If you look at option saying in the money area has more premium, it requires more capital to buy the contract, whereas at the money premium will be at an average range and OTM's premium will be very cheap. It applies for both call option and put option. So while taking a trade, at the money and out the money, which is ATM and OTM, are recommended because we deploy lesser capital than compared to ITM. So the risk involved here are very less. If current month's contract has expired and if we want to take next month's contract, the first week of the next month has very higher premium. So buying 1 or 2 OTM is recommended. The reason why it is very cheap at the end of the month is because of decay. The premium decays day by day till the end of the contract. The another important thing to make a note here is the OTM strikes will go to zero at the end of the month. This is the nature of option. If days are passing one by one, the chance of achieving the target gets decreased. In option Greeks, we will say this decay as theta. There are 4 main option Greeks: delta, gamma, theta and vega. We will talk about option Greeks in detailed manner in another video. And by the way, our next video is about index options. In that video, we will be discussing about how to trade Bank Nifty and Nifty and how to choose right strike prices and etc. If you have any doubt, please let us know in comment section. And if you want us to talk about a specific topic, you are open to give suggestions. If you are new to our channel, please subscribe and hit the like button. Thank you. I will see you in my next video.